Okay, so from last market update to today, we've had two major reports come out. Pretty much the two most important reports that come out. And that is going to be the unemployment, non-farm payroll, and CPI. And they both were counteractive to one another. So on Friday last week, we had non-farm payroll. And it showed the unemployment rate ticking up. We're up to 3.9%. And if you look at it over the course of the past year, you can see the unemployment rate is curling up right now, signaling that likely higher unemployment is ahead. We can see also from the JOLTS report, less job openings, less turnover. So people are staying at their jobs longer. So remember, Fed has that dual mandate, labor and inflation. And about a year ago, maybe 6 months ago, we always thought that it was going to be inflation that would bring maybe interest rates down, right? We saw inflation come from 9 to 3, expecting, 9 to 3, maybe we're closer to that 2% target. But now it's starting to shift, looking that labor is in fact softening, and this unemployment rate that is curling up will be the reason that the Fed may trigger and lower interest rates in the summertime. But then just yesterday, Tuesday, counteractive. We had a CPI inflation report come in hotter than expected. Came in at 3.2% year over year. Again, meaning that last year's prices to this year's prices are up 3.2%. And the two very important charts we look at when we do this is one, we look at it from a 4-year trend. So inflation is supposed to go up 2% year over year. It's normal. It's like wages are supposed to go up 3% year over year. GDP is supposed to go up 3%. It is normal. We live in an inflationary economy. But when inflation goes above that 2%, which we did significantly, went up to 9% about 18, 24 months ago, and we've been 6, 7, 8, now down to 3. We've been above 3% for 35 consecutive months. And I think about 3 years, we've been above 3% inflation, which is drastic. So when you add this up, inflation over the course of the past 3 years is 11% above what that 2% target is. So if inflation, which will likely be above 2% for the remainder of the year, maybe towards the end of the year we can finally get to that 2% range, what will the Fed want? Will the Fed be happy at 2%, or do they want us to break below 2? Because then let's just say we go to 1 or 0, we go to a deflationary month over month, then what that does, that eats into those 9% prints and those 8% prints, and it finally gets us back to our normal, which is going to be like a 4 to 5 year plan. So from that perspective, we can see rates being higher for longer because it will allow the Fed to slow down that 4-year massive uptake in inflation. So again, counteractive between job loss kind of starting to creep up and now a hotter CPI. So what is the Fed going to do? Next Wednesday, Jerome Powell will be talking, and I know he's going to be drilled on this. He's going to be drilled on, hey, we saw unemployment go from 3.7 to 3.9. So he's going to have to be able to say, yes, we see jobs, we see the labor market is still, it's there, it's robust, right? It's not as robust as it once was, but then he's also going to be drilled on, hey, how do we get inflation down to that 2%? Or not drilled, he's actually going to be using that as leverage to again stall out any type of hope for interest rates because they don't want it to happen too soon. So then the last point we'll touch on is inventory. Inventory has increased about 1% the past 5 weeks, which doesn't seem like a lot. However, normally, inventory actually decreases in the months of February and January. So at this moment, we have about 501,000 single-family homes available for sale. This is 21% higher than the same time last year. We do see listings creeping up, right? Listings are about 52,000. Last year was about 48,000. For context, March of 2020, right before the pandemic, new listings were 80,000, so we're still significantly below, but we can start to see, again, more inventory, more listings are finally starting to hit the market, which is a great sign for all of us, and it's a great sign for future buyers out there that you may have more opportunity in the near future. So that's what we have this week. Hope you enjoy it. If you have any questions, definitely feel free to reach out.